Okay, the stock market is going to crash. Do this now. All right, before we get started, I'd like you to go ahead and hit that like button, subscribe to the channel, and hit that notification bell if you find my content valuable. By the way, if you've been watching my videos and you have not subscribed, go ahead and subscribe. That helps you to actually push this video out to people who might need it, and so hopefully it will help them just like it helps you. Okay, we'll get into this. The stock market is going to crash. Do this now. Now I'm going to do several things. I'm going to talk about a recent scenario here, give you some concepts, and like I said, tell you what to do. Do this now. Okay? All right. The recent scenario is, it seems like the world is kind of going crazy right now. One of the big things that's happening right now is we're having a military conflict in Iran. It really is a war. That's what it looks like to me. And here recently, our president actually sent out a social media message where he used a bunch of profanity, and he actually, well, maybe not a bunch of profanity, but he used some profanity, and he actually kind of threatened to annihilate the civilization of Iran. Now, this really spooked the markets, and the S&P 500, the top 500 companies here in the U.S., kind of represents the U.S. stock market. And the S&P 500 really took a dive when the president sent out this social media message about Iran. This is a huge, huge deal. I'm going to take a seat here on a bench. Once again, I'm out by the Harlingen Library. I like coming out here. It helps me to collect my thoughts. But the S&P 500 really went through a dip when he sent out this message. And so what I would like to kind of encourage you to do is if you have been invested during this time and the president sent out this message and the stock market just recently went through its dip here, I want you to bottle that up. Now, since then, it's gone back up. But if during that time when it dipped, you were feeling that pit in your stomach and you were thinking, oh, I don't know about this stock market thing, and it had you kind of shaky and everything, bottle that feeling. Because you need to have that in your psyche, not to scare you, but to have you think about how you're invested. Because you want to invest in such a way that when things happen in the stock market, you're calm. You're actually able to stay the course because you're invested correctly, okay? Now, let's talk a little bit about investing. I often talk about index funds. And I really, really like index funds for a variety of reasons. But one of the big reasons that I really love index funds is for the average individual. It is a simple and easy way to get a good return in the market, at least if the index fund does as well as it has in the past. We'll use the S&P 500 as an example. If you're investing in an S&P 500 fund, since its inception is done about 10%, then you're most likely, or there's a good probability that it's going to do that again in the future. So that's a good place to actually be putting your money in an S&P 500 fund for the average individual. In fact, there's been studies that look at active investors, or actually actively manage mutual funds, okay? And these mutual fund managers that take care of these actively managed funds are the creme de la creme. They're the top. They've gone to the top Ivy League schools and are paid a lot of money to manage these mutual funds. Well, 80% of the time, they fail to beat the S&P 500. So if you just put your money in a broad-based index fund like the S&P 500, 80% of the time, you're going to beat these creme de la creme guys who are experts in funds and they manage these mutual funds. You're going to beat them by just being in an S&P 500 fund. So it's powerful to just be invested in the index, okay? Now, like I said, when the president sent out this social media message, the stock market went down. It since then has recovered, okay? And so now we're in a little bit better time. And so what you want to do is when we're in a time like this, where it's a little bit better, where people are not freaking out at all, now is the time to actually look at your investing and set an investment strategy. Like I said, I often talk about or recommend, and I'm not a financial advisor, so you want to do your own research, but what I invest in and what I talk about in these videos are, like I said, index funds. So you want to look at how you're investing your money. And again, I suggest index funds. I suggest you researching those and get them. And then you want to see how your allocation is by what your risk tolerance is. Like I said here recently, if what happened in the market spooked you and you were feeling that in your gut, maybe you need to add a few other things to your portfolio. Maybe you have, like I have, a total stock market index fund. Maybe you want to put some bonds in there as well, okay? Bonds sprinkled in helps to smooth the ride as the stock market goes up and down, because bonds tend to be less volatile than stocks. When stocks have a crash, or when an index fund goes through a crash with the market, the bond fund tends to be more stable, or it doesn't go down as much at least. And so for me personally, I have an 80-20 mix. 80% of what I invest in are stocks within index funds, broadly based index funds. 20% of what I invest in is in bonds and cash. So you can look at that, and once you have that set to where you're like, I can stick this out with this 80-20 mix or whatever it is, often what's touted is a 60-40 mix, 60% stocks, 40% bonds. And if you can get that tied down right now, then when more difficult times come, you will be able to stick it out while the volatility is occurring, okay? I think about this also in terms of baseball, okay? And I look at major league players, okay? Now, picking a single stock or having a more aggressive investment strategy, like investing only in AI now because AI is big, I liken that to swinging hard to try and get a home run. And I look at major league players. It's just below 20% of major league players have about 10 home runs in their lifetime, okay, in their working career as a major league baseball player, okay? That means that even these creme de la creme baseball players, 80% of the time when they have a hit, it's a base hit, it's a single, or maybe a double. And so they're making these base hits. Well, I liken an index fund to having that consistent base hit that gets you on base and that gets you scoring in the game of investing, okay? What also happens is many of these, home run hitters, as they're swinging away, strike out, okay? So you don't want to strike out with your investing. Get into that rhythm of making base hits, singles, doubles, by investing in index funds, which anybody can invest in and have success as far as investing in the stock market, in index funds. That gives you a broad-based framework to actually work with, okay? So you want to do that, all right? And actually set your investment philosophy so that you're able to stay the course. I think about Jack Bogle. Jack Bogle founded Vanguard. Vanguard is where I invest as far as my Roth IRA is concerned and my brokerage account in broad-based index funds. And what Jack says is he has a phrase about investing. When the stock market is there and it's volatile, it's going up and down, particularly when it's going down, what he says is, don't do something, just stand there. Again, let me say that. Don't do something, just stand there. It's the exact opposite of what that phrase actually is. What that phrase says is, don't just stand there, do something. And in many cases, that makes sense. Something's happening, there's danger or something like that, you're driving and something obstacle is in the road, you don't want to just stand there. You want to do something. You want to evade whatever is in the road. But when it comes to investing, if you have a good investing philosophy, you set what your investing philosophy is. Like I said, mine's 80-20, 80% stocks, 20% bonds, and that volatility comes along and the stock market drops, you just want to stay the course. You don't want to do anything, you just want to stand there. You want to keep on going with whatever you are doing. Like, let's say that you're investing $400 a month, and like me, I have 80% in stocks, 20% in bonds. I just keep doing that whether the stock market is up or down. Here's another neat concept is, if you do that, you're optimizing your investing, okay? I kind of think about it like a product. Let's say that you're buying, I don't know, it's pencils. You're buying pencils, and those pencils are $1 a piece right now, okay? And let's say that they go on sale half off, 50 cents. Do you want to be buying them when they're $1? Or do you want to be buying them when they're 50 cents? Of course you want to buy them when they're 50 cents because you're able to buy more pencils, okay? And if you're going to be buying them all the time, it might be better if when they go down to 50 cents that you're buying more of those pencils. And when they're $1, you're buying less of them. That way, your whole inventory, you're going to maximize when you sell it for a profit later. Like, let's say that later on you're going to sell those pencils for $2. Well, you're making a greater profit when you purchase them at 50 cents. And you're also purchasing less of those pencils when the price goes up to $1. So your whole inventory is more optimized. I hope that that's not confusing. But when you dollar cost average and you just do that $400 a month, you're buying the stock when the stock market may crash, you're buying it at a lower price, and when it goes up, you're buying at a higher price, but it's optimized automatically. Because when it drops, when the stock market drops, you're buying more. When it goes up, you're buying less, okay? So that's a powerful, powerful concept, okay? So you just want to be in there over and over again. So the stock market is going to crash. So what do you want to do when it crashes? Absolutely nothing. You want to keep on doing what it is that you're doing. Month after month, just staying in there, dollar cost average, always be buying, no matter what. That's how you win, okay? Those who become wealthy over time investing is a long-term strategy. They're in when the market is up. They're in when the market is down. That way maximizing, because over time it goes up over time. So you want to be in there for the long haul. 10, 15, 20, 30, 40 years or so. That is how wealth is built over time, okay? So when the market crashes, I think about when we had the global health crisis, okay, where we were all wearing masks in 2020 and social distancing and the whole 9 yards. Well, the stock market dropped, the S&P 500 and the stock market 34%. It had a 34% drop. That means that if you had $100,000 invested when we went through the global health crisis, that means that your balance in your portfolio went down $34,000. So you had $100,000, and then when you look at the balance, now it's $66,000. That is absolutely scary. That will scare you if you don't have the right investment philosophy. If you have the right investment philosophy, like when we went through that, I was working at the grocery store that I work at. And we had the sneeze guards up at our check stands. We were wearing the mask and the social distancing. And what I noticed was customers were actually doing one thing. They were taking this device, this cell phone, and they were all typing on that cell phone. And guess what company I saw on the back of those cell phones? I saw a little Apple on the back of that. That means that Apple was still a valuable company when we were going through that global health crisis, okay? That pandemic. So what that tells you is, Good companies are still valuable even when the stock goes down, okay? Often is the case. It's often things that are happening out in the world that drag that stock price down with it. There's always going to be something happening in the world, some sort of chaos, economically, wars, different things, the economy, layoffs, all sorts of things happening in the world and in the economy and in politics that are going to affect the stock market. And it often does not mean that the underlying companies, that there's anything wrong with them. It's just that when the chaos happens, all of the companies are kind of dragged down during that time. But you can have a smile on your face because you can buy them at a discount, okay? So when the crash happens, not if, it's gonna happen at some point. I don't know when it's gonna happen. But when it does happen, make sure that you have your investment philosophy in place and you're invested in a way that keeps you calm through the turbulence of the stock market. That is how you win. That is how you take advantage when stock prices go down. You're just scooping up more stock at a discount that will be of greater value in the future. So don't do something. Just stand there in the investment routine that you've already set up. Just stand there over and over again and keep doing what you're doing as the stock market goes down, because it will recover over time if history has taught us anything. History doesn't repeat itself, but it rhymes. I learned that from Jaspreet Singh. He has the Minority Mindset channel. A great little phrase, history rhymes. And if history rhymes, the S&P 500 had a 10% return over its history. So if you just invest in a broad-based index fund, you can expect to have those types of returns and actually have momentum and win in the game of investing. Again, if you find my content valuable, go ahead and hit that like button, subscribe to the channel, and hit that notification bell. Again, if you're not subscribed and you've been watching these videos, go ahead and subscribe. I'd also ask you to comment. Commenting does a lot of great things. It also gets that engagement and may help someone else. In fact, why don't you put in the comments how you're investing? What kind of mix do you have in your portfolio? Like I said, I have an 80-20 right now. Again, thank you for coming along with me and listening. Take care.